welcome back. In this video, I'm going to be going over institutional market structure. Now, institutional market structure, pretty simple, maybe a little confusing at first, but it's simply just highs and lows, okay? Highs and lows make up different highs and lows, okay? It's really that simple, okay? So you see here with this little consolidation that we have on gold, pretty long consolidation, but there's going to be something out of this, I'm sure. Some very, very explosive news, probably this NFP, as you see right here in the farm payrolls. But enough of that. Now, what is institutional market structure? I'm sure you probably heard the term short-term low, but have you heard the term intermediate-term low or long-term low? Now, the verbal definitions for those, right? A short-term low is just a low that's formed, right? If I draw a line here and do like this, the low is right there, and we can call that what? We can call that sell side, or it says low resistance, but that's sell side because that's the low right there, right? So that we can call that a short-term low, or if I can call this a swing low, right? That's a swing right there. That's a low. Okay, we call that a short-term low. Now, what makes it an intermediate-term low or a long-term low is the type of lows that form in between that short-term low. So let's take this swing low here, right? This exact one right there. I'm gonna mark that as swing low. Boom, swing low right there, right? Boom, bam, pop, easy. Okay. Now, pay attention here. You see this? Boom, bam, boom, bam, boom, bam. Do you see that? Okay. So, whenever there's two short-term lows in between one short-term low, that makes the key short-term low, which is this one, the key swing low, a intermediate-term low. Okay. So, we have this here. We have this here. Okay. So, we have low, low, in between this low. So which one is the key low? Key low is this one. That's the main one we're looking at, because that's the swing low, okay? These are the ones in between. These are the middlemans. I could call these the middlemans, right? Two middlemans in between the boss and the two middlemans, okay? So these two here are short-term lows. You can zoom in, right? These two are short-term lows. And what are they in between? They're in between another short-term low. What does this short-term low become? It becomes an intermediate-term low. Okay, so two short terms in between another short term creates an intermediate. Okay, simple, right? Now let's expand out on this. Let's expand out now. Just make it a little stupid. Watch this. Okay, watch this real quick. Right, you see this low here? Boom, and then see this here? Bam, right? I'm sure if we jump onto a higher time frame, it'll look way better. But you're probably like, okay, there's two short-term lows in between this main low, so is it still an intermediate-term low? It would be if you didn't. That's if you didn't really look. It would be, but if we look, see this over here? Let's zoom into this low here. We're gonna delete these, okay? Because now we're going on to long-term lows or long-term swings, I guess you could say, because it's not just lows. I always do that for some reason. But you see this? You see this low here? The two middlemans. Boom. Bam. Two short-term lows in between another short-term low. This short-term low becomes an intermediate-term low. Okay? Now, before I say this, right? Before I get any more into this, let's just turn off the charts real quick. Let's meditate. Okay? I'm going to turn off everything, right? Before I get into this, two intermediate-term lows make a long-term low. Okay? That's why they're called short, intermediate, and long-term. Simple, right? Like I said, it's a combination of swings. It's not that hard at all. So let's turn this back on, right? We're just get graceful with it. So we have an intermediate low here. So this right here, intermediate low. If I can even spell that, intermediate low, whatever. It doesn't really matter. So I think I can do autocorrect. Yep. Intermediate low, right there. Okay. Boom, bam, pop. Okay, easy, right? And then we got this here, right? We got this swing low. We don't know what this swing low is categorized as, but we'll see soon. Okay? See that low there? That key low? Do you see it? I think I see it. I see it pretty well. Do you see it? Let's zoom in. Okay. So we do got a swing low here, but what is it? What is it categorized as? What is it categorized as, y'all? We don't know what it's truly categorized as because we don't know if it comes lower because market is open right now, so it can come lower below the swing low. But we have what? Short-term low. Short-term low. What is this now? What does this become? When we have two short-term lows in between another short-term low, what is that? What does this one key short-term low become? Becomes a intermediate low. If I can't even spell that right again. Okay, let's actually try this one. Intermediate. Oh, I spelled it right, y'all. Intermediate low. Okay. Intermediate term low. Okay. Like I said earlier, two intermediate term lows form a what? Uh-oh, they form a long-term low. Look at that. You just jump up. And long-term low. Boom. Right. Intermediate low, long-term low. These two short-term lows form this intermediate low. These two short-term lows form this intermediate low. Those two intermediate lows form this long-term low. Okay. Now, what does the terms mean? The short-term, the intermediate, and the long-term. Okay. Short-term is basically price can take out that point of liquidity or that low. Because when we say lows or highs, those are points of liquidity. Okay. Price can take out that point of liquidity very easily or in a very short amount of time because it's a short-term low. Intermediate is it won't take too long to take it out, but it will take it out later in the future. Okay. And then long term, obviously, you can probably say it now. If you give me the definition, I'll give you 10 seconds. And no, you don't have to pause the video for this. Okay. And you probably said a low that's going to be taken out over a long period of time. It's going to take a long period of time for it to come to. Yes, you're right. If you said that, you are completely correct. Okay. Short term is price can take out that low or that swing within a very short amount of time. Intermediate is it can take out that swing within a intermediate amount of time. And then long-term low or long-term swing is when price can take out that swing in a long-term, like long-term period of time. Okay, a long period is very simple. It's not that hard. It really isn't. It's not that hard at all. It's just institutional market structure. You can also use this with targeting. When it comes to targeting, right? Let's say if you're trading real small, like minuscule time frames, like the 1 minute, right? 1 minute, right? If we zoom in here, let's just zoom in, right? See this short term high right here? Let's say if you were to take a trade like down here, right? You're targeting that short term high because price can take out that high within a short period of time. It's not going to take that long to hit it, and it's going to do it pretty fast. In which it did. Did it do it? Yes, it did. Okay, so this is a short term high. Price came above it in a short amount of time. Okay. Compared to what time frame you want. Okay. It's based off what time frame. If your swing high forms on, if your short term high forms on an hour, it's not going to take that many hours for it to break it. Get it? Very simple. If you're on the 5 minute time frame and your swing low formed or your short term low formed on the 5 minute, it's not going to take that many 5 minute candles for it to break that short term 5 minute swing low. Right? Very simple. Because if we look here, this 1 hour swing high, it didn't take a long time for it to break it, did it? It really didn't. It didn't at all. Nope. It did not. Because then we have, look, short-term low, short-term low. Uh-oh. Short-term low again. So not that hard, man. It's pretty easy, to be honest. So when it comes to targeting, if you say you took a trade down here, right? Let's just draw something around here. Let's just say right there, right? And you had your stop probably at like below this candle, right? Now, around here, there's an intermediate term low. Can you find it? Can you? Let's see if you can find it. It's over here in this vicinity. Let's see if you can find it. It's right there. Right there. And as I'm recording this, I'm hearing fireworks outside of my house for some reason when it's literally the 2nd of September. I don't know why I just said that in between the recording, but it doesn't matter. So here, right, we have this short-term high, then this short-term high, two short-term highs in between a swing high creates a what? An intermediate term high. Boom, right? So you can set your target at that intermediate term high, and it's not going to take too long, but it'll take a longer time for it to hit it. And did it hit it? Yes, it did. Okay. How many hour candles was it? A lot of hours. I'm not counting that, but it was a lot. Actually, you know what? You want to count? Sure, let's do it. from here all the way to here. That's 35 candles, so 35 hours. 35 hours. Really 34, okay? So you get it, it's really simple, okay? It's not that hard to learn, okay? You basically just have to have common sense and just think and be like, oh, okay, if it's a short-term low, then that means it can take it out within a short amount of time. If it's intermediate low, that means it can take it within a not long, but a longer than usual time frame. And long-term lows, it can take it out in between a longer period of time, way longer period of time, based off what time frame you're on. So it's pretty simple, it's not gonna lie. And I did go over just lows in this video, but if you just simply invert it and put it to highs, which I did with this example here, with this trade, this sexy looking 9RR trade, I wish you could have actually took. But institutional market structure is not that hard. And then if you include standard deviation with it, like if you draw, like from here, right? Let's say we're targeting this high, right? And if we were, let's say we were taking sales here, right? From this swing here, you can take your standard deviation, boom, bam, right? From the last swing before that intermediate high is created. You can pay attention and see where the standard deviations land. Looky-o here. Right at the 8th standard deviation. Where do we land? Where do we land at? Right at that fair value gap. Right at that fair value gap. And do you notice, right? Pay attention. Do you notice, right? That this is the first fair value gap that forms after this breakaway gap. Isn't that amazing? Beautiful, right? Very. I think so. Very beautiful. Breakaway gap. Uh-oh, first fair value gap. 8th standard deviation. Wow, look at that. Came right to it and bounced back up. Isn't that amazing? Straight to it. This is actually amazing for me to see in real time. Because I haven't even this isn't hindsight. I'm looking at this real time. Like this is my first time. I said chime. First time drawing this standard deviation. Look at that. Right to it. It came two points below it. 2 ticks, I guess you could say. 2 ticks below it. That's insane. And then what did it do? Oh, pop it right back up. And came back into that intermediate term. But anyways, that's just, a little example I just showed you with standard deviation. I'll teach you standard deviation later. Probably today or tonight, I might do something for you. But anyways, enough of me talking. I hope I gave you a pretty good rundown, and this teaching was a good teaching over institutional market structure. Oh goodness, I need to edit that out. But anyways, enough of me talking. I'll be in this video here. I'll see you guys later. Peace.